taxable brokerage account. This is the baseline everything else gets compared to. Open one at any brokerage firm, deposit money, and buy whatever you want. Stocks, bonds, ETFs, mutual funds, real estate investment trusts. There are no contribution limits, no income limits, and no age restrictions. The cost is taxes. When you sell at a profit, you owe capital gains tax. Hold the position for more than a year, and the rate is 0, 15, or 20%, depending on your income. Hold it under a year, and it is taxed as ordinary income. Every other account on this list exists to give you some version of relief from that. Traditional IRA. IRA stands for Individual Retirement Account. It is a container you hold investments inside, and the government gives you a tax benefit in exchange for leaving the money alone until retirement. The contribution may be tax deductible in the year you make it, which lowers your taxable income right now. The money then grows tax deferred. When you withdraw in retirement, you pay ordinary income tax on what you take out. The annual limit is $7,000 or $8,000 if you are 50 or older. Withdrawals before 59 and a half carry a 10% penalty on top of the income tax. You must begin taking withdrawals at 73, whether you need the money or not. Roth IRA, the same container as the traditional IRA with the tax timing reversed. You contribute money you have already paid taxes on. The account grows tax-free. Withdrawals in retirement are completely tax-free. There are no required minimum distributions during your lifetime. So the account can keep compounding as long as you live. You can also withdraw your contributions at any time without penalty since the tax was already paid. The constraint is an income limit. In 2024, the ability to contribute begins phasing out at $146,000 for single filers and $230,000 for married couples filing jointly. Above the phase-out ceiling, the direct Roth IRA contribution is not available, though a backdoor conversion strategy exists for those above the limit. Traditional 401k, a retirement account offered through an employer. You choose a percentage of your paycheck to contribute before income taxes are taken out, which reduces your taxable income for the year. That money goes into a menu of investment options your employer selects, typically mutual funds. Many employers match a portion of your contribution. The most common structure is a 50% match on the first 6% of your salary. The annual contribution limit for employees in 2024 is $23,000 or $30,500 if you are 50 or older. Withdrawals in retirement are taxed as ordinary income, and required minimum distributions begin at 73. Withdrawals before 59 and a half carry a 10% penalty. Roth 401k, the Roth version of the workplace retirement plan. You contribute after tax dollars. The account grows tax-free. Qualified withdrawals in retirement are tax-free. Unlike the Roth IRA, there is no income limit to participate. Anyone whose employer offers this option can use it. The contribution limit is the same $23,000 cap shared across both traditional and Roth elections within the plan. Employer matching contributions go into the traditional side by default since employers contribute pre-tax dollars. Beginning in 2026, employees earning more than $145,000 will be required to route catch-up contributions into the Roth side only. 403b, functionally the same as a 401k, but offered exclusively to employees of nonprofit organizations, public schools, and certain hospitals. The same $23,000 limit applies. The traditional versus Roth choice applies. One additional rule: employees with 15 or more years at the same organization can contribute an extra $3,000 per year, up to a $15,000 lifetime cap. The persistent issue with 403B plans, particularly in public school districts, is high-fee annuity products sold by outside vendors who are permitted to solicit employees directly. Fund costs in some 403B plans run 2 to 3% per year. At that rate, a teacher contributing over a 30-year career can lose several $100,000 to fees that would otherwise have compounded into retirement income. 457B, the retirement plan for state and local government employees and certain nonprofit workers. It operates like a 401k with one critical difference. There is no 10% early withdrawal penalty. If you leave your job for any reason at any age, you can access the funds immediately and pay only ordinary income tax on what you withdraw. The annual limit is $23,000. Government employees who have access to both a 457B and a 403B can contribute the maximum to each simultaneously, effectively putting $66,000 into tax-advantaged accounts in a single year. That stacking ability is one of the most underused advantages in public sector compensation. SEP IRA, a retirement account for people who work for themselves and small business owners who want to shelter serious income. SEP stands for Simplified Employee Pension. Instead of a flat dollar limit, the cap is tied to earnings up to 25% of net self-employment income, with a ceiling of $69,000 in 2024. Every dollar contributed reduces taxable income for the year. The account functions like a traditional IRA, tax-deferred growth, income tax on withdrawal, required minimum distributions at 73. Setup requires minimal paperwork. The catch for business owners with employees: you must contribute the same percentage of their compensation that you contribute for yourself. That requirement is why solo operators often prefer the solo 401k. Simple IRA, built for small businesses with 100 or fewer employees. SIMPLE stands for Savings Incentive Match Plan for employees. The contribution limit is $16,000 in 2024, $19,500 with catch-up. Employer participation is mandatory. Employers must either match employee contributions dollar for dollar up to 3% of salary, or contribute a flat 2% for every eligible employee, whether or not they contribute. The penalty trap: rolling a simple IRA into any other account type within the first 2 years of participating triggers a 25% early withdrawal penalty instead of the usual 10. After the 2-year mark, it rolls to a traditional IRA or 401k without penalty. Solo 401k, designed for individuals who work for themselves with no employees other than a spouse. The structure lets you contribute in 2 roles simultaneously. As an employee, you can put in up to $23,000. As the employer, you can contribute up to 25% of net self-employment income. Combined, the total can reach $69,000 in 2024 or $76,500 with catch-up. A Roth version is available. The account permits loans. For a high-income person who works for themselves, this is the most powerful account available. At lower income levels, a SEP IRA sometimes allows a higher total. At higher income levels, the solo 401k wins. Administrative requirements increase once the balance exceeds $250,000. Health savings account. To open one, you must be enrolled in a high deductible health plan. That single eligibility requirement unlocks the only account in the tax code with 3 separate layers of tax protection. Every dollar contributed goes in pre-tax, the balance grows tax-free, and withdrawals for qualified medical expenses are tax-free. No other account offers all three. The limit is $4,150 for individual coverage and $8,300 for family in 2024. The funds roll over indefinitely and the account stays with you regardless of employment. After 65, you can withdraw for any purpose and pay only ordinary income tax, making it function like a second traditional IRA for any spending that is not medical. One strategy worth knowing: pay medical expenses out of pocket now, save the receipts, and reimburse yourself from the HSA years or decades later. There is no deadline on reimbursement. On 529 plan, a savings account for education expenses, run by individual states but available to residents of any state. Contributions are made with after-tax dollars. Growth is tax-free. Withdrawals for qualified expenses are tax-free. Qualified expenses include tuition at colleges, universities, and trade schools, up to $10,000 per year for K through 12 private school tuition, up to $10,000 lifetime towards student loan repayment, and registered apprenticeship programs. No annual contribution limit applies, though contributions above $18,000 per year from a single donor can trigger gift tax rules. A change that took effect in 2024, unused 529 funds can be rolled into a Roth IRA for the beneficiary up to $35,000 over a lifetime, as long as the account has been open for at least 15 years. That removed the main objection most people had to contributing aggressively: UGMA and UTMA custodial accounts. These are taxable investment accounts an adult opens on behalf of a minor. UGMA stands for Uniform Gifts to Minors Act. UTMA stands for Uniform Transfers to Minors Act, which permits a broader range of assets, including real estate. The adult manages the account until the child reaches the legal age of majority, which is 18 in most states and 21 in others. At that point, the child takes unconditional control with no restrictions on how the money is used. No contribution limits apply. The tax treatment generally follows the child's rate, though a provision called the kiddie tax applies the parent's rate to investment income above a threshold for dependent children. These accounts count as a student asset on financial aid applications, which reduces aid eligibility more than a 529 does. Defined benefit pension. An employer makes a specific promise before you retire. Stay long enough and we will pay you a fixed monthly amount for the rest of your life. The payout is calculated using a formula based on your salary and years of service. You do not touch the investments. The employer manages the portfolio and carries all the risk. Private sector pensions have largely disappeared over the past 4 decades. They remain common in government employment, military service, and certain union contracts. What a pension provides that nothing else on this list can: guaranteed income that does not end and does not fluctuate with market conditions. The risk belongs to the fund. If the pension is underfunded or the employer becomes insolvent, the Pension Benefit Guaranty Corporation provides partial protection, though coverage limits do not fully cover the largest pensions. Thrift Savings Plan. The federal government's retirement plan available to federal employees and military members. It offers the same traditional versus Roth choice and the same $23,000 annual limit as a 401k. Expense ratios inside the TSP run around 4.005% per year, among the lowest of any retirement plan in existence. The G Fund, available only to TSP participants, holds government securities and produces returns above a typical money market fund while carrying no risk of principal loss. Federal employees covered by FERS receive an automatic 1% employer contribution and a match on the first 5% they contribute, for a total possible employer contribution of 5%. Annuities, sold by insurance companies. You transfer a lump sum or a series of payments, and the company commits to paying you income for either a fixed period or the rest of your life. Three main types. A fixed annuity pays a guaranteed interest rate. A variable annuity invests your money in underlying funds, and the payout moves with market performance. An indexed annuity ties growth to a market index, but caps the upside in exchange for protection on the downside. Annuities can be held inside a tax-advantaged account or a regular taxable account. The persistent concern with variable annuities is fees, mortality and expense charges, administrative fees, and fund fees that can total 2% or more per year, compounding into significant losses over time. Surrender charges, which are penalties for withdrawing early, commonly last 7 to 10 years. For someone who has funded every other account on this list and still wants guaranteed income, they cannot outlive, and annuity becomes worth evaluating carefully.